Hi, good morning, and welcome to Bonhoeffer Capital's conference call and Q&A. We have a number of people still joining, so I'll continue to monitor the waiting room to let you in. But in the interest of time, we're going to get going. Today, Keith will be discussing the continued evolution of Bonhoeffer's frameworks and the incorporation of some new holdings that exhibit growth drivers in slower growing markets. And I'll also include a deep dive on some specific holdings within the portfolio, including FFB Bancorp. As always, this presentation is for informational purposes only and is not intended to constitute a sale, solicitation, or advice. So we invite qualified investors wishing to learn more about Bonhoeffer to reach out to me separately, and we're always happy to connect. We hope this session will be dynamic and informative, so please feel free to submit any questions you might have throughout the presentation right in the chat, and we'll make sure that Keith can address them in real time. So with that, Keith, I'll hand it over to you.
Okay, good morning, everyone, and thanks for joining us. What I'm going to start to do initially here is describe. I'm going to put a little bit of history on here. We haven't had one of these for about a year, but want to refresh people in terms of where we were back then, where we are today, and where we look like going forward in terms of the process that we're enhancing in terms of Bonhoeffer itself. So our initial strategy was focusing on value and special situations in emerging markets, and that worked well before I started the fund, which was probably like in the mid 2010, early to mid 2010s. Then when I started the fund, we continued on with that strategy. Unfortunately, that has not worked as well going forward. And as a result, we've sort of stepped back and enhanced our process, I think, which can provide still a relatively, from a multiples perspective, a relatively low multiple portfolio that has some enhanced growth potential in terms of the underlying businesses themselves, which I think provides a really unique opportunity today. So basically, like I say, we're evolving our strategy right now. If we take a look at the holdings that we've included in the portfolio versus, let's call them the legacy holdings. Right now, they represent about 80% of the portfolio. We still have a few legacy positions, I think, in the portfolio that I believe still are working, and we're going to basically hold them on at some point. I think they either may be taken out or whatnot, but at this point, those are kind of positions when the expected returns decline to closer to when they decline, then we'll roll some of those actually roll those funds over into newer holdings. And that's what we're in the process of doing now. There's been some holdings that historically we thought were going to grow, but not are growing. And at this point, we're in the process of selling those and putting the money to work in what we feel are better opportunities today. So what we're focusing on is, focusing on growth drivers, in some cases in slower, modestly growing markets, the themes of consolidation, translation, and innovation. And then what we're also looking in terms of looking at the managers and seeing what kind of capital allocators are there. So we're focusing on firms that are generating excess cash, and with that excess cash, they can allocate, and we want to find managers that are expert capital allocators. I think, as Buffett has said, and a lot of other people have noted, is over a certain period of time, 5 or 10 years, management is responsible for allocating in many times capital in excess of the market cap. So it's a really important area to focus on and really see what's going on there. And then the other thing that we've started to take a look at, we've sort of included in our process, is there's analysis called destination analysis. This is basically looking at where a company's going to be in 10 to 20 years. This was initially described by Nick Sleep of the Nomad Funds, and we've sort of taken that off and try to review all of our holdings to sort of see, okay, how would this sort of play in some of the companies we have, and make sure that that is consistent with what we are holding in the portfolio. Because in essence, what we're sort of in a race with the other people out there. So you really need to take a look at this on what I believe is more a relative basis in terms of what alternatives can people put their money in versus Bonhoeffer. These are some of the current characteristics of the portfolio. As you can see, we've got a lower than average PE ratio and a higher than average growth rate. That's been trending higher over time. Our size has somewhat increased as we found some really interesting larger companies and have advantages like scale that really isn't available in smaller companies in those markets. If we take over to the right there, these are sort of the categorizations we had before in terms of compound mispricings. Those have somewhat declined because those are primary holding companies with multiple discounts. We've held those over the years, but a number of them have not worked out as expected. And the real reason why is just because of the lack of underlying growth of the business. We've got a number of capital return securities, and those primarily are focusing on companies that are in the more mature markets, but then are returning capital primarily via buybacks and or dividends. And then the combined return gives us in sort of what our target is, our upper teens return from that perspective. Public LBOs, those are companies that are taking on debt to magnify returns. There's a number of those in the portfolio. Consolidation is another theme we've looked at, which is basically companies rolling up other companies in similar markets over time. And then what I describe as capital allocation champions, those are the guys that we think have management that have really done a great job in capital allocation and are making the right decisions. So this just to give you an overview of what's happening here. So what we've done is we have a different starting point, but we're still retaining a value approach, as you can see by our weighted average price to earnings. First of all, we're identifying the firm's destination. We want EPS plus dividend growth to probably be greater than 20%. We're identifying the moats, determining if the moat's widening or if it's shrinking. And we're also looking for management to enhance the moats that they have via operational improvements and capital allocation. These are profiles of some of our current holdings. These three, these are probably in our top 10, each of them. And you can sort of see the characteristics here. You've got very high returns on invested capital or equity, decent growth rates, and then and that would imply a 5-year forward multiple of, in the mid to high single digits, sometimes in the low single digits. And that's the way we've sort of been looking at sort of valuation multiples, is saying, okay, really what we really want to see what the business is going to be selling for in 5 years, not today. So we've basically gone through and reviewed our existing holdings, and we said, okay, if there's no multiple expansion, are these parameters, can we still get the growth that we want? If we can't, then we've sold those off. If we can, then we've retained them. A few of them actually do have those characteristics, and those have been retained. So just to provide you a simple example of how the framework has changed, we really want growth to illustrate how important growth is in regards to investing. Here's a company, Old Dominion Freight Lines. It's basically a trucking company. You can see from the chart here, it always appeared to be overvalued. Now this is Morningstar that's put together a estimated fair value, which is typically what an analyst would do in terms of do a discounted cash flow analysis and coming up with assumptions. But you see what's happened over time is that it was always overvalued. However, the company itself outperformed because the growth really drove the value of this business. So it was always valued, and always it grew in line with its intrinsic value, which was 28% per year, which outperformed the average of 13%. The ROE was 24 and increased to 30. So those are two key characteristics that we look for in some of our new holdings. Here's another example. This is more of like a value stock, maybe what we've historically probably were interested in valuing. But you see here, you almost have the opposite effect. Warner Brothers Discovery has always been undervalued, but what's happened? The earnings have been flat to down. And what's the stock price? The stock price has been a disaster, right? I mean, even though they were undervalued, the stock price declined by about 13% per year, which was actually less than the change in intrinsic value. And so, and compared to the index that was a disaster, ROEs are always subpar. So, I mean, these are just examples of situations where sort of where we've transitioned to. We've tried to focus on the growth guys that we can get for a value price, and trying to stay away from more of these value stocks. And the value stock in this example, companies that have flat to declining cash flows basically due to competitive positions. So this is destination analysis. And so the real question that we ask here is, what will the returns will be generating in 10 to 20 years? It's driven by 3 things: market growth, capital intensity, moats, and competition. So be 4 things. One thing to think about is what's the longevity of the returns of the current firms competing in the market. So let's take a look at, for example, auto dealerships. Auto dealerships have been around for a long time and appear to have been resistant and basically gone through a number of different cycles. Banks is another example. So these banks have been around for hundreds of years, And so what that really says in my mind is those are pretty resilient firms in terms of where they're at and what they've done. And 10 to 20 years from now, I can still see Asbury Automotive as an auto dealer still selling cars. I can see FFB still providing banking services. Some of the other areas that are a little less that way is, okay, do we think Warner Brothers Discovery is still going to be around in 10 years? Do we think that, probably closer to areas where we've invested in and are in the current process of reducing our exposure is some of the TV and radios, the TV areas. Historically, before I started the fund, we did a lot in radio, but then this again goes back to the idea radio may not be around in 10 or 20 years. Are the firms being disintermediated, or are they the disruptors themselves? Can the returns in one geographic? Now, this is another interesting area. So if you look at like banks and auto dealerships, you can say, okay, can the returns in one geographic be reproduced in other markets? And that's a key aspect. I know Peter Lynch has talked about that, but that's one of the key aspects for growth. And what types of scale efficiency benefits have been realized in the past and can they be realized in the future? This is an example of things like if you think about Home Depot over time increased the store count, but then at some point, probably about 10 or 15 years ago, they didn't increase the store count, but increased efficiency. There's a huge amount that can be done in efficiency, and I think that's an area that we've been focusing on in our holdings in terms of that particular area. So here are some examples of where we think there's higher future returns. Distributors with growing end markets, which has been one of our focus areas, niche banks, financial service providers. Software is another one in terms of, and software is primarily due to the high switching costs associated with that. And then where do I think lower future returns are? These include things like legacy telecom and media, primarily due to crumbling moats and just the increasing competitive situation. So this is what we call and what it is described as a sort of investing in growth process. So we're value investing in compound growth. We try to find areas of unrecognized growth where it doesn't show up in the pricing today. Things like M&A, buybacks, and maybe unannounced corporate actions. What we're looking for ideally is a transition from low invested capital to high invested capital firms. As you had seen with in the two examples we provided, Old Dominion's return on invested capital increase. There's a metric called return on incremental invested capital, and that's one of the key things that we look for. We examine market factors, strategy, and capital allocation. And here's some examples of firms where we think have gone from low return on invested capital, moving to higher ones, and these are in the portfolio. Auto Hellas is one. TerraVest is the second, and Academy of Sports is the third. So those are the types of businesses that we're looking to invest in. One of the key questions in trying to find these businesses is where are the profit pools and value chains? So if you look at various value chains, where can we find the profit pools? And that's where we really want to invest. And then finally, the importance of consolidation, which is a characteristic of a number of our holders in an area where we've really seen a lot of interesting sort of activity in terms of companies and find some really interesting investment opportunities as a result. So in terms of value chain analysis, we examine firms that have large TAM value chains. So you're talking about autos. Like for example, in autos, there's a lot of places you can invest in the auto value chain, but there are certain profit pools in certain areas. So for example, dealers and distributors is one area where I think there's a lot more much more of a profit pool than let's say OEMs or even some of the suppliers. U.S. infrastructure, housing, leisure, and then banks. And then we just sort of follow the value chain. We examine things like where's the biggest profit pools, which companies in that particular industry have the highest returns on invested capital and incremental invested capital. And then we're going to examine growth drivers of the large profit pools, primarily taking a look at consolidation, organic growth, and cyclicality from that perspective. So those are some of the, and then we're also looking for transitioning businesses. So these are primarily sort of areas that we focus on in looking for new investments and re-examining our existing investments to see how they stack up against the current portfolio. Then the next thing, this is basically the consolidation of why and when is bigger better. Some cases, basically the basic idea here is you got economies of scale, you can get higher margins and turns with larger size. And there's two types of scale. There's local and national. An example of a local could be like a bank and or a car dealership. Basically, all the economies of scale, most of the economies of scale are local. There's other national products where things across different areas, the scale would be national. Those would be things like, for example, software or other types of products that are sold on a national basis rather than a local basis. And so what you've got here, so there's three areas where you can get cash flow growth. One is organic. And so the advantage of having organic growth is you can have more control and generate returns without incurring goodwill in terms of having to pay someone else a premium for their assets to incorporate it into your business. There's consolidation. There's two types of consolidation. There's geographic and functional area. Entry into new geography would be sort of like let's say a car, a auto dealer or a bank entering a new market. And that would be a geographic area. An example for a bank in terms of a new functional area is the one we're going to talk about today exhibits this, is you hire a technology team to develop more services or more services that are processing and tech enabled from that perspective. And then the other important piece with cash flow is the allocation of the excess. So that's basically, you see that through either buybacks and dividends. And buybacks can be accretive if you actually are buying below intrinsic value, and then dividends, and they're not one above. So that's an additional piece that you can add to the total return puzzle there. And then the other question is, this is an interesting way to sort of approach sort of fragmented markets where there's a lot of smaller players that can be consolidated and a lot of additional value can be created. So these are some of the characteristics that we look for as we call capital allocation champions, a specific, and so the key thing is capital allocation. How are you going to reinvest the cash flow? So these are basically the five options. You can reinvest, pay down debt, repurchase shares, or merger and acquisition. And so some of the benchmarking questions that we ask when this happens is, has management examined all alternatives for capital allocation? What is the return on incremental capital deployed? How many shares when you're talking about share repurchase, how many shares are repurchased at a discount to the current stock price, which is important to tell you how accretive those particular deals are. And have operational improvements been realized? Some examples of this, let's say in the retail industry, would be sales per store, inventory turns, and operational leverage. Looking at those over time, because operational leverage can make a huge difference on some of these businesses, especially when in some of these businesses you can get operational leverage of two times, which will be sort of shown in, okay, what is your, let's say, EBITDA, change in EBITDA for change in sales. So there's a good amount of operational leverage that really can drive some interesting opportunities. And so what we're looking for is growth, good capital allocation with a low or modest valuation. So again, and the best capital allocation is highly dependent upon where the firm is. If the firm is starting out and seeing a lot of growth going forward. So for example, in our portfolio, Academy is in that place where basically they can continue to put stores in their existing footprint, there's demand there, and then expand their footprint. So that would definitely be in the growth area. And if what you want them to do and what they've done is, they can get returns on invested capital of 20% plus. And as long as they can do that, you want them to invest as much as they can in there. I mean, what the advantage of that company is that in addition to that, the company generates so much cash flow that in addition to investing at those types of rate of return, it can actually buy back its stock, which actually provides sort of a leverage benefit. And then the other question that comes from a valuation perspective is how much of the future growth is priced in today. And that's primarily handled by some of the multiples we buy at businesses are not too high. So that's pretty much how that aspect is sort of adjusted or handled. So our goal here is to find what are some of the, and what this is basically, what are some of the themes where we can get 20% total returns with no multiple growth. And one area is recurring revenue from distributors. Distributors compete they compete for the most part, in large fragmented markets. There's a few that are consolidated, but there's a lot of fragmented markets out there associated with distributors. What's happened is most of the participants in these markets are privately held. What that really means is the market doesn't have really other benchmarks to easily compare the company. So there can be some mispricing associated with that. And there's some segments that have no PE involvement. So for example, auto dealerships, to basically buy an auto dealership, you have to get the OEM approval. And a lot of times OEMs will not approve PE-owned dealerships just because they feel that, the business model is not compatible with what the dealers want to do in terms of having a steady distribution partner and consistent distribution partner. Another area we found is niche banking services. There's some efficient spread lenders out there. In other words, having really efficient operations, high return on non-banking services, so like processing and other areas. There's low-cost deposit niches. There's high-yield loan niches like SBA loans. And then what I found in some of these cases is there's markets with less competition historically due to historical consolidation. So, for example, in a number of California markets, the large banks in California have basically consolidated away a lot of the smaller lenders in that market. And what a lot of the large banks do is they say if the relationship doesn't make above X amount, they basically don't want to service them anymore. So this really provides sort of an entree for some of the small, more entrepreneurial banks to really provide some good services and provide, get a decent return for providing those services. And then the real question is, okay, that's a nice goal, but then how are we going to measure those 20% returns? How are we going to estimate 20% or more? So this is a little bit insight into how we try to attempt to do that. The first one is we look at the return drivers. There's net income growth, capital returns, which is buybacks and dividends, and changes in multiples. And so what we have is these are some of the things we look for the newer holdings that we've looked at and we focused on is we want net income and plus capital returns, which is dividends, to be greater than 20%. And then we want the current multiple to be less than 50% of the expected return. And so what that provides us is really two areas where we can win. The first one is, okay, if it's growing at 20%, we know we're going to get 20%. If the current multiple is less than 50% of expected returns, typically things sell for, I would say, like 2 times expected returns. 1 times is what some people use as sort of a threshold, but if we can get it at 50%, we really can get two engines happening at the same time. We can get both income growth plus multiple growth, which can provide some really interesting upside opportunities. And so what we do as part of this is we rank a lot of our holdings by a combination of earnings growth and earnings yield. There's 2 different approaches. I've seen this done. One way is to add them together. That's got its pluses and minuses. And then the other one is to take the expected return divided by earnings multiple. This, I think, was first described by John Neff in one of his books. And so, but in either case, when you sort of rank investments, the two end up, the two are pretty close in terms of the firms that become more interest versus another. And so we try to select the firms that have a combination of both. But the key behind these is not these end numbers, but the assumptions that go into the end numbers and the specifics behind it. And that's where we spend a lot of time doing it stuff like destination analysis and looking at other types of analysis to basically ensure the assumptions going into our estimates are reasonable and supportable. So one of the themes we talked about is recurring revenue from distributors. And so distributors are basically in 2 businesses. You have new and used sales, and then value-added services. New and used sales are one-times, value-added services are recurring. The other interesting note is as the customer base increase, you get higher and higher recurring revenue. And this is one of the huge advantages of consolidation, because usually in consolidation, you're getting more and more customers. So you're getting more and more cost of scale, get more and more recurring revenue and more advantages and synergies associated with that. The one thing about recurring revenue from distributors, they can vary by type of distributor. So in the motor vehicle segment, and we'll show that in the slide going forward, construction equipment and trucks have the highest sort of, recurring revenue. Boats have the smallest. And so what we're trying to look for is distributors that have 90% plus customer retention or recurring revenue. That sort of enhances the business and provides an interesting sort of additional, I would say, sort of protection to the downside. Because if you've got a 90% customer retention or a recurring revenue rate, then you're only losing 10% a year, and then picking it up on the other end it makes that a lot easier, and you can grow into a recurring revenue, a large recurring revenue increase over time. So here's an example of recurring revenues from the motor vehicle distribution market. And so what we're showing here is we've got boats on the left-hand side and construction equipment on the right. And what you can see is the service gross profit and the finance gross profit are more of the recurring pieces. The new and used sales are more of the one time. As you can see, what's happening over time. So this is just a snapshot in time, but what you'll know over time is consolidation happens. More and more of the revenue as a percentage and the gross profit as a percentage go to service and finance. And so you can see you go from boats on the one end where, well, since boat area isn't that consolidated at this point, that majority of their gross profit and new business that's a large percent of the gross profit, like 76%. Versus when you go to construction equipment where they have a much more large installed base, you get a much higher percentage of recurring revenue. And you can see this in terms of the returns on capital. Some of them have very nice returns on capital, and then are very reasonable valuations. And so the two holdings we have in our portfolio amongst these companies is Asbury and Ferry Corp. As you can see, both of them have very good characteristics in terms of both absorption. Now, what absorption is basically the amount of SG&A covered by non-new and used sales, a gross profit, and above 100% is better. Below 100% is not as good from a at least at the current state of where it's at from a downside protection area perspective. So the other yep,
Okay,
sure.
just not to interrupt, but I didn't want you to get too far
Sure.
from it.
Yeah.
Somebody asked if you could just repeat the name of the book you had just mentioned on expected return.
The book. You're talking about the John Neff,
Yes.
yes, okay. So that is from John Neff on investing. It basically, John Neff was a pretty famous value investor back in the 80s and 90s. And if you look in a part of his book, I think it's actually got it right here. It's actually on page 74 of the book. He describes how they at the Windsor Fund actually looked at and sort of ranked various opportunities. And one of the ways that he did that was that they took the total return, which he defined as the amount of EPS growth plus dividends, and divided that by the price to earnings ratio. And that's one way to sort of, on a relative basis, compare companies of how much is the market paying per unit of growth. And then the alternative way is just adding it together. I mean, I think theoretically, John Neff's way is probably correct, but I think in practice, from what I've seen, I've done this primarily with banks. I've done it with some of our other holdings too, but the banks, there's just so many of them out there, it becomes there's a lot more data to do this with. But the results have been similar using both methods. So, okay. So the other area that we found very interesting these days has been niche banking services. And so contains companies that have a combination of various factors. So good efficiency ratio. Efficiency ratio measures the SG&A divided by NIM plus other revenue. Here I have lower than 40%. I think probably the better benchmark is lower than 50%, 40%. There's very few, but 40% would be an outstanding. But I think if you're in the 40s, that's a good number in terms of finding an efficient spend lender. You want NIMs to be 3.5%, because the way to think about it is NIMs is the amount of net interest margin you're getting off the assets you have. You subtract off the efficiency ratio, subtract that out, and subtract off taxes, and that will give you the net amount you get on the assets or the equity that you've invested. A sticky or low cost deposit base, and low NPAs in terms of criticized loan levels. And really that's in our mind more of an area where we look at and say, okay, we don't want to invest in guys that have criticized loans above a certain percentage. There's always a risk reward trade-off here. And you can take a look at things like loan loss reserves divided by NPAs to get an idea of how much of reserves been on it. But we would prefer to have lower amounts of criticized loans and more than enough loan loss reserve covering non-performing assets. There's non-banking services where bankings can provide on-ramps to other high incremental value added services like processing card fees and trust services. And this is an area where there's a lot of innovation too. And you have some smaller banks actually developing new applications using this, which I think is an interesting growth area for some banks. There's low cost deposit niches. There's certain sort of ethnic or low income sort of niches that where people can invest. There's government low income incentivized. Those are like low income housing, which has been on everyone's mind. And there's a number of banks that have sort of focused on that. And I think that's going to be a continuing growth area, no matter who gets elected in this election, because I think that's an area where people want to emphasize the key thing behind that is underwriting decent loans with low income incentivized in a low income incentivized area. There's prepaid cards. Those are guys that basically provide prepaid cards. That's some nice float from that perspective too for banks. And then there's some higher yielding, sort of lower risk lending niches. So SBA lending is an interesting one because you always get government guarantees, and you can also sell the loans in the SBA market and get recurring fees from servicing the loans. And there's also Freddie Fannie multifamily lending, where what you can do in that particular market, there's a specific company we own called Merchants Bank that they just focus on the lower risk Freddie and Fannie. So what happens is if you're a multifamily lender, Freddie and Fannie provide the lowest lowest cost of financing. And what banks can do is they can provide short-term bridge loans while they're going through the paperwork to get it ready, to get the loan ready. And then sometimes this is where it gets a little bit higher on the risk spectrum, is you actually are financing companies to basically do some work to get ready for that process. And what Merchants has been able to do, which is pretty interesting, is they've actually been able to focus on the higher end of that market, the lower risk, higher end of that market, and they've been able to generate ROEs in 20-30% range. So that's the specific example of sort of these higher yielding, sort of lower risk niches that some of these banks have gotten into. One of the tools that we use to come up with spread information, in other words, a tool to evaluate spread lenders, is Sixth Street Partners has put together an interesting sort of framework to think about the unit economics of BDCs, which are primarily spread lenders. And we've sort of taken that and applied it to spread lenders and banks to sort of determine, okay, which groups are providing the best expected returns. And so basically, we think well underwrite, and the other thing that we use this for is we think well underwritten BDCs can provide a low end of expected returns for equity investors in banks, because in essence, even though they're higher than debt, if it's underwritten correctly, you probably can say they're sort of on the low end of equity. So we want returns higher than that. Right now, I think that number is probably in the low to mid teens, and therefore that's where the 20% goal of trying to find companies that are growing by that amount really came from. And so this is just an example. This was in our last quarterly letter of looking at various calculating the unit economics of various banks and business development companies. And if you look over to the left there, you'll see, the one that we just talked about, the Sixth Street, and then you can compare that to other banks, and the banks that we have higher. Now, again, this is sort of a snapshot in time. It doesn't include potential increases. So, for example, we own a good amount of Northeast Bank, but that's based upon the snapshot of the last 12 months. Northeast Bank is one of these banks that goes out there and buys loans from other folks due to either FTC issues in terms of bank mergers or from the FDIC. And therefore, on average, I think their returns on equity are much higher, probably closer to 20%, but it's really lumpy based upon when they buy these various loans from the various entities that are associated with them. So the next thing I'm going to sort of get into here is I'm going to talk specifically about one of our newer holdings, one of the companies that we're probably most bullish on in sort of the niche lending space of banking. The name of the bank is called FFB Bancorp. It's a fast-growing California regional bank. What it does is it provides small and mid-sized banking services to primarily business customers in Central Valley of California. They're located in Fresno, and therefore its focus is Northern Central Valley. And then they also have operations in Northern and Southern California. It primarily works out of one branch. And so all the people that are in those areas at this point are sort of working either out of their homes or For Northern and Southern California, it's a much smaller piece, but it's basically a one branch type of operation. They do provide value-added services over time, and this is where they've really been able to provide some really nice growth in terms of transaction processing. The CEO of the bank used to work at MBNA, and he also, in his following job, was working in eventually leading small and mid-sized banking for operations of Asian and Middle Eastern customers from Asian banks. So that's sort of been his focus. And so transaction processing has grown quite a bit. FFB has its own ISO. It does third processing of other ISOs. ISOs are the groups that go out and collect, basically they aggregate customers that need transaction processing for their credit card. So they would be the person that would go out and go to a restaurant and say, okay, we'll provide you your transaction processing services. They also do SBA loans, which a lot of these companies that they're focusing on really have a need for, and if they qualify for them, it provides them a great low interest rate source of financing. And then what I think is really interesting that shows the innovation of this bank, they've actually come up with a retail point of sale system. They work with a third party where in essence they basically provide like a generic type of a system. And so what they'll do is they'll provide a point of sale systems for retailers, restaurants, these are for primarily smaller entrepreneurs to compete with, let's say, somebody like, maybe an Olo or Toast. And what they do is they will then provide them the actual point of sale system. Since they're an ISO, they'll provide them the transaction processing. And then in addition to that, the software is for free, but in essence, they get the money from the transaction processing and the other services that they can provide these customers. I think what's unique about FFB being a bank, you have other guys out there trying to sell them these processing systems, is FFB can provide them not only those types of systems, but also SBA loans and other services that these small entrepreneurs would need. And California is a very entrepreneurial state. And so I think they're also in a great location to basically, develop and provide these services. Again, they're provided in a low cost manner. Their efficiency ratios like in the 40s. Last year, I think it was 43. It's ticked up a little bit this year, and that's primarily due to the fact that they're investing in technology and creating new. And you'll see later they basically were able to hire a fintech team to create new technology and services. The interesting thing about FFB is they generate consistent EPS growth. They're one of only 5 companies that had 5 consecutive years of 20% EPS growth over the past 5 years. So this is the approach they've taken has really created some really interesting results. The other thing I like about it is the ESOP, an employee stock ownership plan, is the largest shareholder of this company. So basically, the employees are aligned with the mission of the business. Again, these guys have taken advantage of sort of reduced competition from consolidation over time in their specific market and throughout California. Management compensation is reasonable at 7% of net income, and they own about 23% of the stock. So I think these things have really provided an interesting. This is one of a number of banks that we own that are, I guess you'd describe them as nouveau banks. FFB was founded in the late 90s. A number of these banks were founded in late 90s, early 2000s of just people in the local community that wanted to start a banking institution. And what FFB found was they were doing that, but then and they basically found the new CEO, Steve Miller is his name, basically at the right time, and it worked out great for them in terms of them putting it together. So another interesting thing in terms of the total addressable market, they have a large and growing TAM by geography and new service. They think that over the next, they say, I guess longer or midterm, which maybe translates into 7 to 10 years, that they can get 6x. They can be 6 times the size they are today. So they think that they can grow most of their business is existing in Fresno, and they think they can double that. And then they think that doubled size can be about the same size as the business in Northern and Southern California. So there's a really great opportunity here for a greatly incentivized and a team I think has all the experience to put this together. So the other interesting thing is ROEs increase from 4 to 26% over time, and the return on incremental capital is close to 35%. And that's what this sort of shows here. This is historically taking a look at the changes of invested capital. So on average, you can see the ROE went from 4.6 to 26, 25, 26 right now. The incremental capital, which is the next thing down there, returns on incremental capital are in the 30s. And so if this continues, which I think it will, it provides a really interesting opportunity. So Steve Miller joined the company in 2025, and you can see I think the real accomplishment is here. When you're small, I think the bank has carried somewhat of the momentum, which has been in the first few years, but being able to continue to provide these high returns on an incremental invested capital going forward, I think is where the key piece of this is. And how he's really done it is he's implemented operational improvements and he's entered new service markets with new processing type services, geographic markets. And so that's really what's really happened here. It's really at this point, I think it's been a success story and will continue to go on. This is a way, and I think if you look what's going to go forward, this is again sort of being conservative. Their ROE is probably it's in the mid 20s. You can see from the precinct. If we assume, let's say 20% organic growth going forward, and maybe a little bit less, they've announced a 5% repurchase. That gives you 25% sort of growth. And what this is showing is over time what that would sort of translate into. If you're buying back 5% of the shares and you're getting EPS growth, it gets you on a compounded basis over time. It's increasing somewhere in the 30% range. Historically, their EPS has been about 38% over the past 5 years and 100% over the past 10 years. What's exciting about this business is that over time, they have this combination of services that basically when you're a bank, you have to put aside a certain amount of your capital to basically make new loans and grow the loan book. But they actually have other sources of revenue from float associated with processing to basically offset that. So they don't need capital to grow. They have the processing basically funding the loan growth. And so in essence, you get so on a net basis, it's really it's a capital light business in the fact that you can use your processing float to fund your loan growth. And there's other businesses that have done this. I mean, I think the biggest ones have been guys like Pathward and the Bancorp have a similar kind of model where they're able to use float to offset loan growth. The one challenge for them though is it's a $10 billion asset cap where all of a sudden if you go above $10 billion, you charge less for your transaction fees. Now, FFB is a long way from that, but those two banks are probably, I don't know, probably 30-40% away from that. So that I think is going to limit somewhere to their growth, but FFB, I say it's got a long way to go to get there. The other interesting point about this is this company intends to uplist this year into the NASDAQ. Right now it's trading in the pink sheets. With it trading in the pink sheets, you're going to have small funds like ourselves and other people buying it. But once it gets listed on the NASDAQ, then I think the opportunities open in two avenues. Well, the total stock market index funds are forced buyers once they enter the NASDAQ. And then the second thing is that the small growth portfolio manager will start to look at these things and say, okay, yeah, this is a really good growth company, and I want to have some in my portfolio. So there's like two other, I'd say, non-market factors that are basically it's going to drive interest in this stock. So here's an example of one of the things that we do is we rank all of the stocks, all of our what we think are our best ideas on more quantitative type basis. And so if we look at this, so that total return is EPS plus dividend growth, the total return divided by PE, which is the John Neff metric we talked about before. So it ranks high on both of those. And here's some of the other areas. They've got the net interest margins are almost 5%. They have a large amount of fee income. The loan growth's growing like 25%. And again, that's being funded in part by the processing of fees that they've got. They have the management ownership at 22%, especially with the ESOP, I think is really, really interesting. And the criticized loans are reasonable. They have 1% criticized loans. What's interesting, I'm saying, is the CET ratio is high, and with the processing, it allows them to do simultaneous buybacks with a really underlying good growth strategy, which I think is a really interesting type of a situation. And there's a few companies, there's other companies outside banking that we've seen this too, but those are the kind of situations we really like where we have the ability to buy back shares at a reasonable amount. Because I think the correct way to think about buybacks is not necessarily what the value is going to be today, but what the value is going to be in 5 years. And if you can buy it at a discount to what the value is going to be in 5 years, then you want to maximize. And again, this all goes back to an assumption of trying to find growth businesses, and with the buybacks will continue to basically, because I think what some people look at buybacks is they just look at the current price. They don't look at what the future price is, which in my mind is the correct way to approach buybacks. But you also want to do it in a business that has somewhat amount of stability, so you can get your estimate has a less error in it in terms of where it's at. To sort of sum up here, so FFB generates excess cash flow while supporting market growth. We talked a little bit about that as a growing CET ratio, which allows them to buy back stock as the business is growing. It's only selling at 8.8 times net income now, so that's pretty good given its growth profile of 25% plus. The management really uses capital allocation tools effectively. They've reinvested into new services and new geographies, which is where they should, given sort of the growth and the ROE numbers that they've been able to achieve. Recently, they onboarded a fintech engineering team to continue to provide new fintech and processing services. And they announced a share buyback plan. So again, we've got modest valuations compared to history, and the expected growth is 25% plus, which today implies a PE 2028 PE of around 3.7, which in my mind is really cheap for this type of a bank, and hopefully we'll get a number of different effects multiplying on each other here where it gets listed, it continues to grow, it continues to get interest, and we'll sort of see this thing sort of play out going forward. And I think that's it. Let me take a look at the chat thing here, at the chat.
Great. We haven't had any questions come in.
Okay.
We'll certainly invite anybody that would like to submit a question via the chat, or you can go ahead and unmute yourself if you'd like to submit it live. Keith, we did have a question come in previously, which was on a holding that you haven't discussed, which is just an update on TerraVest and what you're thinking about the valuation, kind of given some of the dynamics they're seeing right now.
Sure. So, I mean, TerraVest is I think it's a very interesting business. It has a lot of the characteristics of businesses that we like. TerraVest is a company that is in the exciting business of making for petroleum or for propane and other types of sort of LNG and natural gas types of things. And so they make tanks for small tanks, big tanks. They also have a division that does furnaces. And so it's that type of a business. And what they've done, which I think is really unique, is most if not all the businesses in this space are privately held. And they're companies that are owned by small entrepreneurs that have started and built out businesses. And TerraVest provides a way for these owners to exit and basically leave a legacy for their business. And these guys have successfully done this. They're very price sensitive, so the amount they pay is about 5 to 6 times cash flow by the time they're done. They're able to use operational improvements and scale from buying to get down to maybe 3 to 4 times. So, I mean, what they're investing in is, it's 30% sort of incremental returns on invested capital for that business. And so it's a really interesting business. Now, what's happened recently is the stock's up like over 100% this year. Now, I think what the market is fine. There's been a number of things that have driven that. First of all, they've continued to perform really well. The second thing is they've actually, before this point, they didn't do conference calls. They didn't do much with the street. This year, they had an introduction from a number of folks on the street in terms of starting coverage and those types of things. So I think it's really a nice confluence of events, and that's what we like to see, where I think there's some really interesting opportunities where you can have a combination of both underlying business economics growing, but then in combination with, let's take a look at what's going on with the markets, and is it going to get more liquidity? Is it going to get more coverage? Is it going to get more? And so FFB Bancorp, I think, is in a similar kind of a situation, where once it uplists on the NASDAQ, you'll get the same sort of effect that you had with TerraVest. from that perspective, and it's selling at a low price. Now, TerraVest right now, if we take a look at the pro forma free cash flow going forward, it's selling around 14 times, 14 or 15 times. The and the return, the way I calculate is returns on incremental capital is in the 30s. And so at this point, it's had a good run, but I think it's tough for me to really see, it's a getting as long as it continues to get those types of returns on invested capital, I think it's going to be a decent business because it's tough for me to see in the market getting 30% returns on incremental capital and that for only 14 times earnings. I have a tendency, as you can see by our weighted average PE on our portfolio only being 8 times pretty sensitive to price. But I think the one thing over time, we've sort of evolved from being so price sensitive to finding, okay, let's find some interesting growth opportunities and see and price not really driving the decision, but being more of a secondary consideration versus including fast growth. And I think the growth in this business has done well. Management, it is really, I think, undercompensated. They're well incentivized. The whole setup there just appears, in my mind, to be something that I really haven't seen before in terms of developing low cost, disciplined approach and basically focusing on operational improvements. It reminds me a lot of Teledyne, when Henry Singleton has done a similar kind of a thing where basically, he basically bought a bunch of higher valuation companies with his stock in the 60s. And then in the 70s went through and implemented a bunch of operational improvements. So the returns on equity just went through the roof. These guys remind me of a similar kind of that. And what I really look at is they have built a great M&A engine, and the fuel for that engine is relatively modestly priced private businesses in the tank market. And the tank market in some areas is geographically focused, and there's large amount of other geographies they can get into. And when I've talked with the CIO, who primarily is the guy that goes out and develops deals for these guys, he said that the pipeline is just really good. I mean, I like the way they approach it too in terms of M&A. Go out, they have their CIO basically goes out and gets to know all the owners, the private owners of these businesses by going to the conventions and developing relationships with them before they even, get into being an acquisition candidate. And I think that in my mind is the best way to try to approach it, as opposed to getting a bunch of brokered deals that turn into auctions. So it's, in my mind, given the uniqueness of what they have and the operational improvements where they are, I really think it's a unique business. But yeah, I mean, selling for 14 times in my mind is not too bad if you're getting 30% returns on incremental capital.
Great. Thanks, Keith.
Mhm.
Give one more minute, but haven't seen any more questions come in. So we certainly appreciate everybody's time this morning, and hope to
Well,
do more of these in the future. Oh,
so
Keith,
so
did you have some?
so Jessica, yeah, wasn't there a question on that came in earlier on some of the
Oh,
other?
yeah, thank you for
Yeah,
that. Yes. Yeah, actually, another question had come in prior to, just wanted some updated thoughts from you on some other holdings, including Academy, Asbury, and North American Construction.
okay. So for each one of those, so this is an example of, I pulled up something here we had talked about before, return for North American Construction. Now, North American Construction is an interesting business. Historically, it's in a pretty commodity kind of a business, and you can see by looking at this, the returns on equity before the 3 acquisitions they did in 2018 were pretty mediocre, very cyclical. They primarily, what these guys basically do is they move dirt. Their primarily initial focus was in the oil sands region. And then they've expanded out where they do some what I would say, mine management operations in the US. And they do some of this dirt moving type of work in Canada in the eastern provinces. And then recently they bought a large Australian company that does similar types of things. But what these guys seem to focus on is finding contracts where they're the largest provider. It's basically in inclement climate, so they can basically get really good pricing on these things. And so as you can see here, when they did the three acquisitions, it was transformative. The ROEs went up like in the low teens to 20. And then now with this new acquisition, it's probably going to be closer in the 20s to 30s. And that gets us really interested in terms of return on equity. What's really happened, which was not expected. Now, this is data probably from 12 months ago. What's happened is the operations in the oil sands area has been pushed out, and a lot of it was due to weather. And that business when is not as resilient as I thought it would be. But what's actually happened is the business in Australia is much more resilient and growing a lot faster than what I thought it would. So in essence, while I think my initial assessment of the oil sands business, it's not a bad business, but I don't think it's necessarily going to be it's not going to be it's not going to be their growth engine. The growth engine is going to be in Australia. And therefore, if you take a look at the numbers here, what's happened as opposed to in 2024 having 120 million, it's probably pushed out to 2025. So all the and a lot of it, and the reason rationale management is given is just the weather up in the oil sands really made it. The work's going to be done. It's just not going to be done when we thought it was going to be done. But I think the offset to that was the growth in Australia. So if they can get the oil sands operations up to this amount they think, plus this additional growth in Australia, I think there's going to be a little bit of a tailwind from that perspective. I mean, the one thing that that's the story on North American. I think it's just been deferred, and the market is therefore become more skeptical of the amount. But if you take a look historically, what they've done, they've put together a pretty good business here. Um, in terms of Academy, I think it's a similar story. They had decent growth. It's sort of been pushed out. I think a good portion of their customer base is low to middle class folks. What these guys do is they sell, basically sporting goods, equipment, and apparel. So their biggest competitor is Dick's. Dick's has been able to do well on a relative basis because I think their customer is more affluent than the typical Academy customer. But what Academy's been able to do, I think, is provide a more broader selection and basically been able to develop decent rates of return on their projects. But so they had a goal of $10 billion of sales and a 10% profit margin, $1 billion within, I think initially it was 3 years out. This was done in 2020, call it 2022. It was 5 years out, 27, 28. But what's happened is, given the weakness in the customer bases, I think that has just been sort of pushed out. So again, that's one of these things where it's just like, I think it's still going to happen. The plan is still good. It was just pushed out just because of economic weakness amongst the demographics that they serve. And then the third one is Asbury. Now, Asbury, what they've done is they've gone out and done acquisitions in what I would say is sort of their core market. So what they do is when they buy a dealership in a new core market, then that allows them to buy incremental dealerships for very high incremental margins. And the second piece of the Asbury story is the incorporation of internet into their overall operation. So again, this goes back to operational improvement and basically being on people's radar in terms of selection of a car, and then also the ability to come in and do a test drive and then buy the car online is sort of a combined online offline kind of experience. And so they're sort of working through that. And I think going forward, I think they're going to do really well since they do have a good number. What I would say are the marquee dealerships, which are primarily luxury, Honda and Toyota. Honda and Toyota, I think, are especially very good franchises in the fact that they are very good at limiting the amount of inventory that they provide to dealers, so they don't have to deal with incentives and that kind of stuff. So I think it becomes a win-win in both. And if you look at the number of dealerships that Asbury has in those for those brands, I think it's very high. And so I think overall, um, the challenging thing for dealers is people are still trying to figure out what is the normalized earnings. Is it higher than pre-COVID, or is everybody going to regress back to pre-COVID? I think for Asbury in particular, business is much better. They bought a number of dealerships that are in markets that are much higher quality than what they had pre-COVID, but their business continues to improve. They focus on key metrics like, revenue per employee, and those are going up, automation and making sure all that works together and providing a good seamless experience. So I think part of it is basically doing that. They have made, I think, they have made some errors in initially who they chose to be GMs in some of their dealerships, and they basically replaced them with new folks. And so I think that's part of what's happened here too, is they bought dealerships and haven't didn't make the right decision right out of the gate. But what I see encouraging is they recognize the issue. Their approach has allowed them to recognize the issue and then replace them with the appropriate people. I mean, you can sort of take that as you will. It can either be a plus or a minus, but from my perspective, I think it definitely can be a plus. And there was also issues that a lot of their dealerships are in places where the weather wasn't good, which can be plus or minus, but that's sort of, since they do have a dealership group that's out in the west, in the Mountain West, where the weather can't is not 100%, but I think, something that may be affecting them like other some similar to Academy is, they're not, although they do have luxury and stuff, that's not like what their focus is like there may be for some of the other dealerships. The other thing I think they've done, which makes a lot of sense at this point, is their stock is so cheap. It makes sense. It's much better economically for them to buy back stock than it is to buy more dealerships. And that's sort of like what they've been focused on. And that's what they're going to be focused on going forward. So I think that is the key, in my opinion. That's going to be one of the key changes in capital allocation, which should enhance performance going forward for Asbury. So I think that's sort of where they're at now. I still think if you step back and you take a look at the long term, I think I had this in a letter. I think it was not this quarter's, but the previous quarter. If you go back 10 or 15 years and you take a look at the growth rates of pretty much all of the dealers, I mean, you get between 15 and 20% growth rate over that period. And most of that's due to consolidation or buying back stock. And I think what's interesting about the dealers at this point is they really have two great options, right? I mean, if they can find an accretive deal, then go out and do a deal. But then the other thing is they can buy back stock because the market's pricing them as though these things are not gonna be around, or what are really at prices that, in my mind, from a long-term perspective, don't make sense. And so, that's my at least take on those three names. They all continue to be the Asbury, is one of our larger holdings, as is Terravest is one of our largest holdings. I would put um I would put NOA and an Academy in more of, I would say, not really second tier, but on a weighting in our portfolio, they're probably about half of the other two. And from a weighting perspective. So I think that's sort of, and I think that's probably the right sort of, and for me, the right weighting to do it. I mean, Academy, it's, even though the model is great, it's in retail, which is a tough business in and of itself. And then North American is one where, it's a show me model, because I think a lot of guys are involved in the business. It's outside of the niche that they're in, the business is different. So for them, they're going to have to show that, okay, once they get the Western Canada assets moving in the right direction and performing correctly, with the growth of Australia happening at the same time, if that hopefully will happen in the next 6 to 12 months, then I think it'll get the multiple that probably makes sense. But I think what's held them back has been just some of the some of the situations where some of it's beyond their control, in terms of what's going on, in terms of, especially in my mind, I think the mistake that I had made in that was assuming that the oil sands business was going to be a growing and stable business, and it's not turning out to be quite that way. I mean, I think it's still a good business, but it's turning out to be a lot more volatile than I originally thought.
Great. All right. Well, thanks for that, Keith. And if you did have a question and didn't get a chance to ask it, please reach out and we'd be happy to address it offline. And we did record this event. We will be sharing it and we look forward to staying in touch with everybody. All right. Have a great day. Thanks so much.